Good evening, everyone, and welcome. My name is Nick Liebert with EXIT Realty. Thank you for joining us tonight on our How to Improve Your Credit Score in 50 to 100 points in as little as 30 days. It is absolutely possible for those of you guys that are connected with me on social media. You may have seen on my Instagram and Facebook stories about an hour ago, I sent a screenshot of my recent credit score. I'll tell you, this is a personal conversation for you, for a lot of people, so I decided to actually film this, my segment of this live with you in my home, coming from my home to your home, because of course we're all at our homes right now because of the current situation. But this is such an intimate conversation about your credit, about past mistakes you've made or current situations you're in. And it's a conversation best had between you and a trusted advisor, like a lender, maybe your real estate agent from EXIT Realty. That's why we're here doing these educational series. This is one of many things we talk about. We talk about personal finance, health and fitness, charity, community, and of course, real estate. The object of all this is to help you improve your credit, because it's not just about buying real estate. Of course, we at EXIT Realty would love for you to buy real estate and sell real estate with us, but it's that your credit score affects all areas of your life. And it's something that, unfortunately for me personally, again, I like to share my own story, because this doesn't come from a place of judgment in terms of our having a credit repair clinic for you. It comes from me, from my own personal experiences. I unfortunately did some things to my credit when I was younger. When the real estate market crashed in 2009 and 10, I got in all kinds of debt, or I was already in all kinds of debt and couldn't pay my bills and really messed my credit up. And that was a very dark time for a lot of us in real estate. And I'm not afraid to admit that I had that issue. And I'll tell you, I paid my creditors back, paid my credit cards off, and my credit score went from it was low. I think 590 was the lowest it went. Marla, who I'll introduce you in a second, can tell you how low it was at one point. I don't think I could have qualified for a stick of chewing gum. So if you are in a bad situation right now, I can relate, and your EXIT Realty agent can understand and help you. But what I did was some strategic things in order to improve my credit and get it back to where it was prior to the market crash. For some of us in COVID right now, recently, we've had a wonderful year despite everything going on in COVID. A lot of our agents have had a record year. We're so excited and proud of them for that. I myself had a really good year in real estate, but at the beginning of COVID, I used my credit cards just because I want to make sure I had cash to pay our office bills, and my credit score went down because of that. So for everyone here tonight, your situation is unique to you. So we're not going to tell you, oh, you have to do one thing or another specifically as a group, because obviously each individual situation is different. What we're going to tell you tonight is that your individual situation can be improved in as little as a month. What I did recently, simply paid those credit cards down but not off. That's one strategy that Marla's going to talk to you about. If you pay your credit cards down below a certain percent but not completely off, that shows the credit card companies not only that you use credit responsibly, but that you actually need it, versus just paying them off at the end of every month completely, like I used to do, thinking I was the best consumer in the world. So there's all kinds of things to do, but it starts off with seeing actually what your credit score even is, what issues are on your credit that you may or may not know about. All of us, at one point or another in our lives may have had someone else, run something on our credit, or we forgot to pay a bill, or moved and didn't see a bill come in. All kinds of stuff goes on. So we understand that. But we also know that there's some huge opportunities right now in this real estate market. These interest rates are at absolutely record lows. They're near what we call negative interest rates. Good evening to you, Cassandra. I see a couple of you we have a lot of people on here tonight. So bear with us if we have any technical difficulties, or you've got questions that don't get answered quickly. We will get them answered. And anybody we don't get back to tonight, we are going to give you Marla's information at the end, because actually she's going to run this meeting in just a second. You don't have to listen to me. But I will tell you this much, is that there's huge opportunity in the real estate market right now. And your credit score affects, again, as I said earlier, not just your ability to buy real estate, it affects your property insurance, or property insurance bills, some of your car insurance bills. There's all kinds of odd things that credit affects, not just your ability to buy real estate. It affects your affordability and opportunity all over your life. And I wish I'd known that when I was younger. I wish I tuned into seminars like this, and more real estate companies were doing things like this, because it's needed. And it's even needed at my age, and when you have been doing good in the world, sometimes things happen where you fall backwards and slip. And we are here at EXIT to help you back up. But there's somebody else here that knows even more than me about all this, a lot more than me actually about all this, because she's the person that helped me build my credit twice to good points. And I'm really appreciative of her. She's going to tell you much more about this tonight. She's going to break it down in detail for you. But before I introduce her to you, I do want to give one more plug for Exit. Obviously, I think you know why I'm doing that. I love working with all our agents here at Exit. And specifically right now in this market, here's what's going on. The interest rates are at these incredible record lows. Affordability is huge because of that. We feel like there may be some price drops, some price reductions, and some new things coming on the market over the next several months that if you don't take steps to either correct your credit or improve your credit now, you're going to be in a situation where you miss out. We don't want you to miss out on those opportunities, whether you're a first-time buyer or an investor. This is all huge for us. So everyone, please get in touch with your Exit Realty agent after this seminar. If you have further questions, talk to Marla. But let me talk to you about Marla and introduce her. Marla Barch has been one of my preferred lenders for over a decade. I think we're actually closer to 12 years now, me and Marla. I'm reading some of your comments on here. Good evening to all of you as well. It is amazing to me how much Marla has done for me personally with my credit, with my ability to purchase real estate, invest in real estate. I've been a buy and hold person way in the past, a flipper more recently. Some of you guys saw how I got into some hot water with some flips and overextended myself in that. And Marla walked me through that process and got me out of it, and really has helped me invest powerfully in real estate and empower others to do so. So Marla Barch is with Cross Country Financial. I worked with her even before she was there. She's a wonderful lender who, the unique thing about Marla in the industry is that number one, she knows so many of the loan products, rehab loans, new construction, all of that stuff, all the different loan types and nuances that are out there. First-time buyers, if there's something you need as far as like low down payment, she knows all of that. But more importantly, for all of us, including myself, that at one point or another needed some help with their credit, Marla is probably the only lender I know that will sit there and actually help you with your credit. A lot of people, they put you on a third-party credit bureau, and there's some great credit repair companies out there. Don't think I'm talking bad about everybody, but I will tell you there's also some people out there that will charge you $500 or more, sometimes thousands, when you and a lender really should have sat down at the beginning and seen if you could have done this yourself and probably done it best with yourself and a lender walking you through. Marla is so patient and so wonderful. So I'm actually going to turn the screen over to her. I'm going to make her the host, and she's actually going to be with you here the rest of the time. I'm going to go show some houses in a second. I really appreciate Marla being here. I will be on for a few minutes. If you do have any messages for me directly, any questions, I'm happy to help. But your Exit Realty agents are your host tonight, and your star is Marla. So without further ado, I'm going to turn it over to Marla now. And I believe, Marla, we need you to unmute yourself and turn on your presenter mode. She's unmuted. She's halfway there.
Hi guys, how do I turn on my presenter mode?
Yay. And I'm going to mute myself.
But I don't know how to, did you make me a host or whatever it's called?
Yep. So all you got to do is share your content.
Okay. Oh, I see why I'm. Okay, you guys can see me now?
Yes, we can. All right,
Okay.
guys. Marla, thank you.
Perfect, thanks, Nick. All right, so Nick gave a pretty good introduction, but just a little bit more briefly. So I've been in the lending industry for 16 years. I've always had this belief that everybody can buy a home. It's not a matter of some people can and some people can't. It's just a matter of how much education and coaching people need to get to that point. And so I've always taken that part of my business very seriously as far as coaching people and helping them get to that point that they can qualify. So over the years, I've done a lot of education, myself, starting in the very beginning, so I could learn as much as I could to help my clients. So whether that was learning more about the credit system, whether it was learning about investing in real estate, I was at every workshop, I read books, I did a lot of everything I could to learn as much as I could so I could be a resource to my clients. So definitely real estate, like Nick had alluded to, and I'm sure most of you know or you wouldn't be on this call, real estate is the easiest way to build wealth in America. It's an amazing tool that we have. You know, a lot of countries, people aren't able to just buy homes. It's designated only for certain people. But in America, everybody can buy a home. As long as you educate yourself, get the right tools, get to the point that you qualify, everyone can buy a home, everyone can buy investment real estate. And for most Americans, that is the largest source of wealth that most people have. So definitely we encourage you to get involved in that game. And like I said, if you need some coaching or education to get there, there's a lot of tools. Obviously, this is one step. There's books. One of my first books that really had an impact on me was Robert Kiyosaki's Rich Dad, Poor Dad. It really just helped me understand money and capitalism and how real estate plays a role in that. So, you know, like most games, if you don't know the rules of the game, you're not going to be very successful. So capitalism and wealth building, I look at it like a game. And if you have the rule book and you can learn the rules, anyone could obviously be more successful when you have that advantage. So, so let's start in with credit. Let me share the screen here. Okay, I think that worked. If someone could just drop in the comments.
That works.
Okay,
yes, that
perfect.
works.
Thank you, thank you. Okay, so again, this is just the first page. We're talking about building credit, specifically in this case for home ownership. I am sharing the screen that has the building credit for home ownership screen, right?
Yes.
Okay, just want to make sure it doesn't show on my screen. Okay, so obviously tonight we're talking about building credit specific to home ownership, but credit obviously can help you in a lot of arenas, you know, whether you're trying to buy cars, get student loans to send yourself or your children to school, build businesses and get loans for that. There are a lot of advantages to having good credit in a number of arenas. How do I get to there we go. Okay, so the first thing to know is that credit is not always intuitive. So a lot of people have ideas of what they think would help their credit, and those are not always the right things. So definitely get professional recommendations before you do things. Like one big misconception is people always think, oh, if I just pay off and close all my accounts, my credit score will be great. And that's one of the most damaging things you could do is closing accounts. So definitely just make sure you're getting the right information before you start taking action. Okay, also I want to touch a little bit on, before we go specifically into credit, a little bit into what credit you need to qualify for a mortgage. Because there's a lot of misconceptions about that. What is the right score? What's on your credit report? What are the things that are important? And there's a number of things we look at. So obviously the score is one thing, but there are other things as well. Have you had recent bankruptcies, foreclosures, other things like that? And I'll touch on that a little bit later. But as far as the credit score, so there's, like I said, a lot of misconceptions out there. Different loans have different requirements. So VA and FHA loans actually don't have minimums, or, you know, could go down to 500 technically, but that doesn't mean that if your credit score is that low, you're actually going to qualify, because what happens is the underwriting system balances your strengths and weaknesses. So if your credit is low, they want to see a lot of other things that are very strong. They want to see you have, you know, a high down payment, a lot of money in the bank, a strong job history. So they balance the strengths and weaknesses. So lower credit scores can qualify if you have other strengths to balance them out. But what happens is that a lot of banks have what they call overlays. So even though FHA and VA will allow your credit scores to go down into the 500s, a lot of lenders have their own requirements on top of that, where they say, well, even though FHA would allow this loan, we don't want to do loans under 640 or 580 or whatever the number is. But just know that those are not across the board. Those are those lenders' guidelines. So if you have a credit score under 640 and your bank is telling you you don't qualify, it doesn't mean you don't qualify. It means you don't qualify with that bank. So you may want to talk to other lenders who don't have that overlay to see if you may qualify. You know, obviously the other option still is to build the credit and get over that point as well. The other thing that we're going to distinguish between is building credit versus credit repair. So credit repair is focusing on the negative things on your credit report. If you have collection items, late payments, bankruptcies, foreclosures, other things that are negative, credit repair helps clean up those things. Credit building is talking about building the positive part of your accounts, your open and active accounts. And that's the majority of what we're going to focus on tonight, because that is actually 60% of your credit score is based on that open and active part of your account. Only 40% is based on those negative items. So while it does help to clean those up, we definitely need to also be focusing on building. I've had people come to me fresh out of credit repair and say, okay, I paid my money, they cleaned up my credit, all the negative stuff's off, I'm ready to go. And their credit scores were still in the 500s because they didn't build anything. They had no open credit cards, no open loans, nothing that was built. And then the other thing that I want to distinguish is when you're qualifying for a loan, most banks will give you what they call a pre-approval. So basically you apply for the loan and they tell you yes or no whether you actually qualify. And all that's looking at is whether the bank wants to lend you the money, okay? So for what we're looking at is, sorry, I got a little distracted there. So what I do is a little bit more comprehensive. It's not just looking at the question of will the bank lend you money, but it's what I call a home buying plan. So it's a little more comprehensive where it's looking at the big picture. It's looking at what is the right budget based on not just how much the bank wants to give you, but how much you are comfortable paying in your budget. What's the right loan program, doing side-by-side analysis of these options. What's the best PMI type? You know, some coaching on things like this if you need to build credit or save more money or other things like that. So the home buying plan is a little more comprehensive, that it really digs in and focuses on education and coaching to get you where you need to be. And part of the reason that that's important is because a lot of these pieces are interrelated. So the credit building, a lot of people are just focusing on the score. What is the score I need? What is the score I need? But your credit report also has on it your debt. Okay, and so your debt to income ratio is another piece needed to qualify. Different loan programs have different requirements of what the maximum for the debt to income ratio is. And sometimes the actions you take to build credit might not be the same that will help your debt to income ratio. One may help and it may hurt in the other area. So when you're taking a more comprehensive look, you're looking at both of those pieces to make sure your debt to income ratio is where it needs to be, as well as your credit score. How do I check? I want to make sure, I want to have the comments up at the side in case you guys have questions. Except I don't know how to see it.
They don't have any questions yet.
Okay, perfect. Yeah, if someone wants to just be the designated person to jump on once Nick goes to showing, so let me know. That would be helpful, then I don't have to look. Okay, so let's move on to the details about credit building. Okay, so as I mentioned, your open and active accounts are 60% of your credit score. So that is the most important piece of what we're looking at. So we really want to make sure to establish that part of your credit as strong as possible. A lot of people assume that your credit score starts at the top and you only lose points when you do bad things. But it's actually the exact opposite. Your score starts at zero at the bottom, and you have to build your score by doing the right things. And the right things include opening accounts to build your credit. So how many accounts should you have? You should have at least 3 to 5 open and active accounts. That is the ideal of what the credit bureaus like. If you have less than 3, you're not going to get the highest score possible. If you have more than 5, that's fine. Don't close accounts. Like I said, closing accounts hurt your score. But if you're just building, you don't need to open more than 5. If you're just building your credit and you actually don't have any credit, there are a couple of ways to get started. So one, which is the easiest way to really establish a credit score, is what's called authorized user accounts. So if you have a family member that has good credit and established credit cards, they can add you to their credit card as an authorized user. Now, they don't have to actually give you the card. This isn't about spending money or taking their card and going on a shopping spree. It's just about it reporting to the credit bureaus on your credit report to help your score. So if someone in your family is willing to help you with that, just for a period of time that you can establish credit and then set up your own, that's a huge advantage. I know I did that for my son when he turned 18. I put 3 of my credit cards that were all in good standing, so they had no late payments. They had high credit limits, and the balance was very low in relation to the credit limit. I added him as an authorized user, and literally within a week, his score was 780, which was higher than mine was at the time. So that is the first thing I would look at, is if you don't have credit, or even if your credit score, you have some credit, but it's not good, that will instantly bump up your score. And the good thing about that is once you bump up your score, it's easier to get to the next level once you have that first boost up. Okay, now if you don't have an option to get on someone's credit card as an authorized user, or even with that, your credit is still a little bit challenged, you may have to start with what's called secured credit cards. So secured credit cards, pretty much anyone can get them. You don't need to qualify in the sense that they're looking, is your credit good enough, looking at your income, looking at other factors. The way it works is, let's say it's for $300. You give the bank $300 and they hold it in an account, and then they give you a credit card for $300. So they're really giving you a credit card off your own money. So if you don't pay it, they already have your own money. So it's no risk to the bank, but it reports to your credit bureaus just like a regular credit card would. So you want to manage it how you would manage a regular credit card. It's going to help build your score. So secured credit cards are perfectly fine. If you are doing that, you do want to shop around a little bit and compare the terms. A lot of those cards have fees that to me are just a waste of money. So you want to find ones with, if there are fees, the lowest fees, or if you can find some with no fees. The interest rate doesn't matter so much, because what you're going to see is I'm going to recommend you pay it off every month. If you pay your credit card in full every month, whether it's a secured credit card or a regular credit card, there is never any interest you pay. You only pay interest if you don't pay it in full. If you're making those minimum payments, that's where you're paying interest. So if you pay it in full every month, there's no interest. So at this point, I really don't care about the interest rate, because you're not paying interest. But those fees, if there's an annual fee of $200, or I saw one that had monthly fees of $12 just for the luxury, just for, the opportunity to have their credit card. So the fees are a waste of money. So try to avoid the fees. Okay, so that's how many credit cards, so how many accounts you should have open. Next, we want to look at how long have your accounts been open. The longer your accounts are open, the more it helps your score. So obviously, if you're just establishing your credit, they're not going to be open that long, and that's fine. But the longer you've had them, the more it will help. If you're getting added as an authorized user to someone's account, the longer that account has been established, the better. If it's been open for 10 years, that's better than 3 months, but either way, it's better than not having it at all. So we want to try to keep accounts open for a long period of time. So that's the problem with closing accounts, is then your average length of time you have your accounts open is very short if you're closing accounts. Okay, the type of account. So the credit bureaus like a mix of different types of accounts, okay? So one type of account that we're most familiar with are credit cards. They fall under a category called revolving. So revolving, if you think of a revolving door, you can go in and out and in and out. Credit cards are the same. You could borrow money, pay it back, borrow it again, pay it back. Okay, so anything that's revolving, that's one category of credit. Another category is called installment. So that's like a car loan. So you have your loan and you make a payment every month, typically the same payment unless you're paying a little extra, and you keep making that payment and pay the loan down a little every month till it's paid off. That's installment. So they typically want a balance, some revolving, some installment. If you can also have a mortgage, though, that's good to have a little bit of a mix. So if 2 to 3 accounts, I would say, are good to have credit cards and maybe a car loan, a student loan, things like that. Now, I wouldn't say go out and open loans just for building your credit, because then you have debt, And like I said before, that's negatively going to affect your debt to income ratio. So if you need a car anyway, you know, that's one thing. Or if you have a car loan already, keep it open, just make that monthly payment, don't pay it off. But don't necessarily just go out and buy a car just to build your credit. So, so you want to be cognizant of not taking on too much debt while at the same time, you know, you're doing what you can to build your credit score. But revolving is very important. If you only have installment, if you only have a car loan and some student loans and no credit cards, that's not going to help your score as much, because the credit bureaus really want to see that you are capable of handling credit cards, handling revolving credit, pay it down, borrow it back, pay it down. So that's an important factor. One other thing on revolving is, actually, no, that comes up later. Sorry, I'm forgetting what order I have things in the presentation. Okay, let's talk about how you handle your accounts. So obviously the first thing that's most important is making sure all of the payments are on time. With technology nowadays, it's pretty easy to set up automatic payments. So whether it's through the credit card company's website, whether it's through your bank's website, automatic payments are definitely the best way to go, because then you never risk missing a payment. You know, it's not like, oh, I was on vacation and I forgot or something happened. You never have to think about it. So if you set that up, even if you're, you know, for me, I have mine automatic set up to the minimum payment due. Now, typically I pay it off in full, like I said before, so I don't pay interest, but I have the automatic payment set up for the minimum just in case I forget. So I don't get a late payment if I don't pay on time, which actually that happened to me last month. We were so busy, I totally forgot to pay a credit card. But because I had that automatic payment on, it was great. I did not have a late payment. I just didn't pay it in full like I normally do. So the automatic payments are great. The other things you can do, obviously, you know, however you manage your other bills. If you have reminders in your calendar or alarms you have set, or, you know, with technology, there's a number of ways to make sure you're making that payment on time. But that is really important, because late payments are not reversible. Maxed out credit cards are reversible. You pay it down and your credit score jumps back up right away. But if you have a late payment, that's on there. Unless it was actually an error, it's very difficult to get those off. So on-time payments is really, really important. Okay, revolving. Let's talk about managing your revolving credit card, your revolving accounts, which are mostly credit cards. It also covers lines of credit, but mostly credit cards, okay? So credit cards, the first thing is you want to keep what's called your utilization low. So your utilization is how much of the credit you're using. So let's say for easy math, you have a credit card with a $1,000 credit limit. So the limit means how much you could spend. But just because you can spend $1,000 doesn't mean that you want to. Spending $1,000 on a $1,000 card is what's commonly referred to as maxed out. You do not want to max out your credit cards. That is the worst thing you could do for your credit, okay? So we want to definitely limit that. So everywhere in the range of that with the, sorry, let me phrase that again. What we're looking at is what's called the utilization. So that is what percentage is the balance in relation to the credit limit. So again, if it's a $1,000 credit card, let's say you have a $500 balance. You're using half of the credit limit. That's a 50% utilization. So you hear different numbers. A lot of people will say under 30% is good. Ideally, under 10% is the best. You will have the best score if your credit utilization is under 10%. Now, the lower it is, the better, okay? So if you're at 90 now and you're able to get it down to 50, that's still great. That's gonna help your score, but under 10% is definitely, gonna get you the absolute best score. So the other thing to know is the utilization, excuse me. The credit balances, which are what measures your utilization, is reported on what's called the statement date. So this is not the date that the bill is due. It's not when you have to pay your bill. It's when the statement actually closes and they drop it in the mail and send it to you. So some credit cards will say this statement is from September 4th till October 3rd. So October 3rd is your closing date. Some of them refer to it differently. They say closing date, end date, cycle date. Whatever that closing date is, most credit cards report on that statement date. So that's the date that's most important when you're paying attention to what's going to report to the credit bureaus, okay? So if your credit balance is at 50% utilization, but you know it's coming up that it's going to report next week, go ahead and pay it down. The fact that it was at 50% will have no impact on your credit score unless it's on the day that it's going to report to the credit bureau. Okay, so credit utilization. Okay, so then the other thing is that a lot of people do use credit cards a lot because it is the easiest debt to use. But it's not the best debt because, like I said, what happens is then your utilization becomes high and the cards become maxed out. So definitely looking at installment debt instead will help with that. So this is the thing that I see that most often will boost people's credit scores very fast. So if you have some maxed out credit cards or even credit cards at 50% of the credit limit, if you open up an installment loan, so in this case, it would be called a personal loan. If you open a personal loan and you pay off that credit card debt, let's say you have $5,000 of credit card debt, and you open a personal loan for $5,000 and pay off the credit card debt. Now, common sense would say, well, what's the difference? You still have $5,000 of debt, whether it's on a credit card or a loan. Yes, your debt is exactly the same. But because the credit scoring model really cares about that utilization, you now don't have maxed out credit cards. You have credit cards with very low utilization, and it doesn't matter if the loan is at the full amount. So oftentimes I see people score jump up drastically from that specific trick. So, I mean, it's hard to say how many points because it's different for everyone, so I don't want to promise, but I've definitely seen people who've had scores jump up as much as 90 points, you know, within a very short period of time, simply from shifting debt from a credit card to a loan. So personal loans is one option. Another option is retirement accounts. A lot of people have 401k or similar retirement accounts that you can borrow from. So if you have a retirement account, you can take a loan from that, use that loan to pay off the credit cards. It'll have the same effect. The retirement accounts actually often have lower interest rates than personal loans though. So I would probably look at that first, unless you're specifically reserving the retirement account to use for your down payment, which again falls back into why the home buying plan is important, because we can look at all of those pieces together as a comprehensive plan. So if you're not saving the retirement money for your down payment, you can use that, take a loan against that, pay down the credit cards, and you'll see your score jump up right away. If you don't have that option or you don't want to use that money, you can look at the personal loans. Not to endorse any particular sites, but these general sites like Credit Karma, NerdWallet, things like that, what they do is they aggregate data from lenders. Those companies themselves are not lenders, but you plug your information in and they'll say, okay, based on your credit score, here are some lenders that may lend to you. Here are the interest rates, the payments. So you can, it helps you basically shop around and compare. So if you're looking for a personal loan, you could look on those sites, Credit Karma, NerdWallet, similar sites to that. One other thing about that is if you have a credit union, definitely check with your credit union. I know a lot of people have it through their jobs. People, for instance, who work for CTA, I know they have one. Some of the other organizations in the city, often some that are affiliated with unions and whatnot, they have credit unions. Credit unions are great for getting those personal loans as well. So again, yeah, if you can shift your credit card debt to installment debt, not paying it off, just shifting it from one to the other, you'll see your score go up. On that topic too, you definitely want to have a system to track your score. So as you're making progress, you can check and see what the results are, how much your score has gone up. I personally like Credit Karma, but there are a number of sites out there. A lot of them are free, and they're what we call a soft credit pull. So every time you look at it, it's not hurting your score. A lot of people are afraid, oh, is it pulling my credit? Is it going to hurt my score? No, those are soft pulls. So a lot of them, like Credit Karma, are free. And of course, nothing is truly free. It's free because they make you look at advertisements. So don't get sucked into the advertisements unless, again, you're looking for something specific like a personal loan. But they will advertise to you. But Credit Karma, if you pull it up, they let you refresh it once a week. So once a week, you know, you can have a designated day. Sunday's my credit review day. You pull it up and you look at it and you say, okay, so that credit card I paid down, I see that's reported. My score went up this much. So you can track it, because if you don't have a way to track and hold yourself accountable, it makes it more difficult to hit your goals. So you want to have that regular tracking and accountability to stay on top of it. One more quick note on that is that the websites, these credit scores you see on those websites are not the same scores I'm going to see when I'm looking to approve you for a loan. And that's okay, because they will trend together. So even though my credit score will be different than what you see on Credit Karma, if you see your Credit Karma score go up, my score will also go up. They'll move together, even though they won't be the exact same score. So it's still helpful to track it, even though just keep in mind that the score you see isn't necessarily the same one that I will see. Okay. Credit inquiries, speaking of which, a lot of people have heard that having too many credit inquiries can hurt your score. And while that is true, I think people are way too concerned about this. If you have more than about 4 or 5 in a year, maybe it will affect your score 2-3 points. It's not significant, but it will have an impact. So you do want to watch it. But in order to accomplish some of these other things we've talked about, opening credit cards, opening loans to shift the debt, you will have to have your credit pulled. And so it's okay to have your credit pulled, just do it selectively. Do it in a case where you think the chances are good you're going to get qualified. Don't do it in a way where, you know, certain lenders you could probably Google and find out certain lenders are known to be difficult to qualify, right? They only target people with the strongest credit. So if your credit is not the strongest, don't apply for that credit card because you're wasting an inquiry. So definitely use the inquiries. Don't be afraid to use them because they're going to hurt your score, but use them selectively. But even if you lose 2 or 3 points on an inquiry, but you gain 20 points because of a new credit card, you know, it's obviously a net gain, and that's going to benefit you. One other thing back to the credit cards, the credit limits. The more available credit you have, the better. You always want the highest possible limits. That's going to have a huge impact on your score. You can, again, you don't know exactly how many points you're going to get for any particular thing, but I've seen people's credit score jump up 30 points just from increasing their credit limit, not paying off anything, not doing anything else, just, you know, you have a $1,000 credit limit on your card, you get them to agree to increase it to $10,000, so you've increased your available credit $9,000, your score is going to go up. So you definitely want to ask your credit card companies to increase your credit limits regularly. Now, that goes back to the credit inquiries, though, because some companies only do a soft credit pull where it doesn't count as an inquiry, and some do a hard credit pull. Capital One, for instance, does a soft credit pull. So you can ask as often as you want. You can jump on every 3 months and go on their website and click credit limit increase request because there's no harm. Others that are doing a hard inquiry, you kind of want to balance that. You want to, again, try when you think it's likely they might approve it, but you don't want to have too many hard inquiries if you think it's not, you know, it's not likely to get approved. No questions yet?
Yes, Marla, there are questions in the chat.
Okay, let's pause and do questions then. I don't know if I can see it. Does someone want to just read them to me? I don't know how to get into the chat from this view I'm looking at. Or I guess I can stop presenting for a minute so I can see them. Now I can see the chat box. Okay. Which secured credit cards do you recommend? I don't have a specific one I recommend, but what I would do is check with your regular bank. Often banks have them, but if you just Google online, you're going to come across all the companies that are, how do I say this nicely? I mean, really just trying to take advantage of people with bad credit, and that's why you're going to see the ones with the high fees. So I would maybe start with your bank. Whoever you bank with, a lot of regular banks do have them, but I don't have any specific ones in mind. Nick says that First Premier Bank has some, so that's one option. What about student loans? Is that a roadblock? Okay, student loans is another issue. So student loans don't necessarily affect your credit score too much, but they do affect your debt to income ratio. And so that's why, like I said, with the home buying plan, you look at that overall picture. So there are different loan programs that look at student loans differently, and some penalize you more than others. So some loan programs will qualify your monthly payment as if it's 1% of the balance. So for instance, if you have $100,000 of student loan debt, which I know some of you, your eyes are popping out of your head, but that's very common. I see it every day. If you have $100,000 of student loan debt, some loan programs will assume 1% of that balance, which is $1,000, as the monthly payment. So when you're looking at your debt to income ratio, let's say your monthly income is $5,000 and they're assuming this monthly student loan payment of $1,000, your debt to income ratio is already 20% before you even add anything else or the new house. So obviously that is not favorable. We don't want to do that. Some loan programs will use the actual payment. So a lot of people are on what's called income-based repayment plans. So that's a program where they look at your income and they say, okay, based on your income, we think you can afford, let's say it's $150. Even if it's still $100,000 of student loan debt, the payment's $150. Some loan programs will allow you to qualify on that $150 program. So if you have a lot of student loan debt, we definitely want to align you with the program that will look at it most favorably so you can qualify for what you're looking for. So again, that doesn't necessarily affect the credit per se, but that is part of the home buying plan, so we can make sure that we get you into the program that will be most beneficial for that. Do lenders look at how much you can spend in determining your lendability? For example, if I have a $15,000 limit, I owe $1,000, but I have $14,000 to spend, do lenders look at this as negative? Because no. No, if you have $14,000 available credit, we're not going to look at that as negative because you could go spend that. We're going to look at that as positive because it's responsible that you aren't spending it. Basically, what we're going to assume is that the historical way you've managed credit is the way you're going to continue. So if your current credit cards are at less than 10% utilization, we're going to assume that's the way you manage your debt and that you're going to continue doing that. So yeah, no, we're definitely not going to penalize you for that. So that is a good question. What about teachers in the teacher retirement system? We can't borrow against our pension or 401k. Yeah, there are definitely some programs you can't borrow against. Pensions, usually you cannot. So yeah, in that case, you just have to look at personal loans or other options. Yeah. How much off is Credit Karma and the scores? So there isn't an actual formula. It's really different for everyone. I have seen it as much as 50 points off, but I've seen some that are also within 10 points. So there really isn't a formula. And just a little background on that, because this really confuses people. A lot of people think your credit score is just a very specific number, and that's what it is. And the truth is that the credit scoring model is a formula. Okay, so it's a formula that's calculating what is your risk. But the thing is that it's weighted based on the industry. So if you have your credit pulled on the same day from a mortgage company, a car loan company, and a credit card company, they're all going to be different, because a mortgage company wants to know more how you've handled housing debt. A credit card company wants to know more how you've handled credit card debt. So they actually weight the formula so that the number comes up as a result of how likely you are to do well with that type of debt. So the credit score is going to be different with everyone. But yeah, there isn't really a trend. You know, I've even seen with Credit Karma, like often Credit Karma scores are lower than what I see, but I have seen a few times where it actually was higher. So, I mean, you just really, oh, I'm sorry, I said that reverse. Usually it's higher than what I see, but I've seen a couple times where it was reversed. So yeah, there's no real formula for that. What do the 3 different credit bureaus have different scores? So again, that's because they all have slightly different formulas is the main thing. The other thing is sometimes certain accounts only report to 1 or 2 bureaus. Like collections are good for that. They may pick, we're only going to report to TransUnion, Experian, but not Equifax. So your Equifax score is higher. But mainly it's just that they each have their own different formulas. What do you suggest for independent contractors that write off everything for taxes and show a loss of income and want to purchase a home? So that you need a custom analysis for. I mean, the bottom line is that if your net income is too low, you're not going to qualify, right? So you have to be careful You know, obviously I can't give you tax advice. You need to work with your accountant on that. But if you're really making a lot more money and you're writing off way more than you really have, then, you know, obviously you want to be careful to make it more realistic so you can qualify. The other thing that actually helps with that too is multi-unit buildings, which is another topic I'm very passionate about and we've done trainings on. If you're buying a multi-unit building and you're living in one unit and renting the others, the rent from the other units will count as part of your income. So if your income from your job or being a contractor or self-employed is not as strong, that income can actually help offset that. So that's another consideration. Good question. So because of COVID, my salary was cut. And so due to that, the underwriters say they have to pay off some of my credit cards. Yeah, so basically COVID is really tricky. They've added a whole bunch of loan guidelines that didn't used to be an issue before. They're very concerned about people's income more so than they ever were before. So if your income has been cut, they will qualify you off your current income. If your income gets restored back to its original income, which I've been seeing happen to a lot of people, that it was only cut for 3 or 4 months and now it's back, you can qualify back at your current income. So if you were furloughed, but now you're back to full income, we can use full income. We're not going to penalize you for having been furloughed. We're not going to penalize you for having had your pay cut. We will qualify you for full income if you're at full income. But yeah, if your income is currently cut, you do have to qualify off that. So you can either pay off debt or some of these other things I'm talking about with shifting debt. Sometimes if you shift debt from a credit card to a personal loan, not only is it helping your credit score, but it actually may reduce the monthly payment. So that actually may fix it as well. Or if you take a loan off your retirement account to pay off the credit cards, then there's no payment against you at all. We don't count the loan payment for the retirement against you. So there are some other ways to kind of move around debt to try to qualify with that without necessarily having to pay off the credit cards. Capital One has a great secured credit card. Yeah, Capital One in general does a lot of things well. They're very lenient towards people who are working on building credit. So they will approve you when your credit score is lower, whereas some other banks, I don't want to name names, but some won't approve you unless you're over 750. They don't want to talk to you. But Capital One is good for people with low credit scores. And then I haven't used their secured credit cards, but yeah, Regina is saying they have good ones there. Didn't credit scoring recently change over the summer? So there are always different credit scoring models that are out there, and they're coming up with new ones and shifting things, and it's generally all the same thing. It's still the same things they're looking at, the same factors, the same general rules. Even if they shift to different models or whatever, it all still applies the same. Okay, so let's jump back to the presentation. Share. Okay, so we've talked about your open and active accounts. So again, that is 60% of your credit score. So that is really the main thing you want to be focusing on. However, a lot of people do have closed and negative accounts. And this is the part where we call credit repair, is cleaning up the negative items. So you can certainly hire credit repair companies, and like Nick said, there are some that are better than others, so you want to screen them, get referrals, maybe look online to see what they're offering. Some of them do a pretty good job, some of them not so good. So definitely you can check into that if you want to, or you can try to do some of this on your own as well. So there are things like judgments, bankruptcies, short sales, foreclosures. These things are going to affect your mortgage qualifications regardless of your credit score, okay? So a lot of people, I don't want to say a lot of people, but I've heard some cases where people have actually gotten bankruptcies taken off their credit report. And they think that means their bankruptcy is gone, no one's gonna find it, it's not gonna affect them. So underwriters have basically a stalker system that pulls public record from everything. And so they will still know you had the bankruptcy. Now, if it comes off, it'll probably help your credit score. I don't know anything about taking bankruptcies off your credit report. I've heard people say that, but that's beyond my understanding. But these are things that will affect your qualifications. Some things as far as loans, there's waiting periods. So if you have a Chapter 7 bankruptcy, for instance, FHA loans require you to wait 2 years before you can qualify for a mortgage, which is perfect because you can take that time frame to rebuild your accounts. After you've had a financial hardship, the best thing to do is jump back in and start rebuilding. A lot of people will stick their head in the sand and say, I don't want credit cards anymore, or, I got in trouble last time, I don't want to get in a situation. But that's going to keep your credit score low. So you want to start rebuilding as soon as you come out of a bankruptcy. So Chapter 7 would be a 2-year waiting period. Chapter 13, we can actually qualify people while they're still in it, as long as they've had a year payment plan with on-time payments. Short sales foreclosures, you typically have to wait 3 years. But again, the main thing is rebuilding. I've seen people 2 years out of bankruptcy with scores in the 700s already. So it's definitely, a great opportunity to kind of start from scratch when you don't have debt and really rebuild from there. Other negative things. So you've got collections, charge-off, repossessions, late payments, unpaid income taxes, unpaid child support, which yes, that can report on your credit report. So these are things that can be worked on. In some cases, I don't want to get too much in the technicalities because first of all, again, credit repair is not my expertise as much as credit building. But from what I've heard, of course, if the items are not accurate, you have means to dispute them. You could dispute them with the original company. You could dispute them with the collection company. You can dispute them with the credit bureaus. And any way you dispute it, there are laws that state that those companies have 30 days to prove to you that the debt is valid. And so if it's not valid, you can use those methods. I've heard other people talk about that if there are certain things about it that they're reporting incorrectly. So let's say the debt was valid, but they didn't report it correctly, or there's something wrong with it, that there are I don't want to say loopholes, I guess you would say, that you can dispute those things. And again, this is something you can dig more on with credit repair or talk to the credit repair experts on that. But so collections, if you get a collection off your credit report, which means it completely removes it, that's the best as far as how it impacts your credit score. Now, if you have a collection with a balance and you pay the balance, either in full or you negotiate and settle for less, but either way it had a balance and now it says 0 past due balance, none is due, that may help a little bit, but in that case, the collection is still on your credit report. It just has a 0 balance rather than the previous balance. So, so it's not as good as completely coming off your credit report, which is the best. And in some cases, it can actually hurt your score. I know this seems counterintuitive, but one of the things they look at is how recent activity is. So if you have a collection that's 5 years old, it's pretty old, so it's not having as strong of an impact in your scoring model. Now, if you go ahead and pay it or settle it, now it shows the date of the most recent activity is 1 month or just a couple of weeks. It may actually initially have a negative impact because it's saying this is a collection account with a more recent activity. So you have to be a little bit careful about those. And it's hard to say exactly, how it's going to go because, again, the credit scoring model is a little ambiguous. So we know the general trends, we know what to expect, but little things you don't always know for sure. So definitely we should review that. If it's just a couple of small collections and they're older, in a lot of cases, I will recommend not doing anything with it because you don't want to risk that they're going to report as more recent activity that could hurt your score. Unless, again, you're able to completely get it removed, in which case that's the best case. Charge-offs and repossessions. So I see those pretty regularly. They don't necessarily mean that you won't qualify for a loan. You can qualify for a loan if you have a charge-off or repossession. So yeah, again, it's kind of case by case. So there are some things that are general across the board, and there are some things that the answer is different for different people depending on their overall credit situation. So I have definitely had people get loans with charge-offs and repossessions though. So that's not definitely, it's not a deal killer. It's not something you definitely have to pay off because I know sometimes those can be, thousands of dollars that obviously you don't want to spend the money that you've been saving for the down payment on that, and now you don't have down payment money. So definitely, again, have that consultation before you start paying things off because you don't want to hurt yourself while you think you're doing something that's going to help. Late payments, again, unless they're inaccurate, those you typically can't remove, but they are very impactful. So just the main thing is just try to prevent them, make sure everything is on time. Unpaid income taxes and child support are a little bit different. There's the one question of how they're affecting your credit score, but there's the other question that they could be liens on the property. So sometimes those could be a prevention from qualifying for a mortgage at all, unless you specifically get on a payment plan and take certain actions to get those moving forward and show that you've been successful with the payment plan. So that would be something we'd have to look at again on a case-by-case basis. Okay, so in general, next steps, again, with my system, it's what I call this home buying plan, which really breaks down specifically for you what you need to do. It's not just a generalized, okay, everyone needs to do this, because it's really going to be different for every person. Some people may need to do the thing where you shift credit card debt to, pay it off with a personal loan or a retirement account loan. Other people may need to do something completely different. So you can take some of the information I gave you today and use it, but really the best is a personalized plan, because you really want to make sure what's best in your situation, and then you can make sure you're taking the right actions rather than call and say, yeah, I paid everything off and closed it because you thought that's what was best, and now your score is actually 50 points lower, which, like I said, that does happen. So once you have the home buying plan, the other thing I put on there is I'll give you your target purchase price. So even if you're not quite ready to buy your house yet and you have to do certain things to get to the point that you qualify, your realtor can set you up with a search. And it's good to start that early, because then, hold on, let me jump back here, because then you can start getting a feel for the market. You can get a feel for what's going on, what purchase prices in different neighborhoods can buy you. So if you've been tracking it while you're working on the credit, once you're ready to go, you will know, okay, my target purchase price in this neighborhood can buy me this type of house. You can identify when houses are good deals because you've been tracking that. So I would still recommend connecting with your realtor as soon as you have that home buying plan and get set up on a search so you can start tracking that. And also it keeps you motivated. You see houses you like and you're like, okay, I'm going to get there. I'm going to get there. It helps keep you motivated. If you don't have a realtor yet, as Nick said, the exit agents are fantastic. I've been working with them for a dozen years, and they're all very, very skilled. A lot of them, even the newer ones, they get coached by Nick, so they get his expertise personally. So if you don't have an agent, we can definitely set you up with someone who's an expert in, your neighborhood, depending where you're looking to buy. But that would really be the next step, is to get your custom home buying plan so you know what you need to do, get set up with your realtor so you can start on the search. And then really, I think that to me is usually where you see the light go off for people, because a lot of people that feel discouraged, they don't know if home ownership is for them. They don't know if they're going to be able to. Maybe they were told no by a bank before. That's really, once they get the personal plan, everything kind of comes into order, because then you understand exactly what you need to do. It's not an ambiguous idea that, okay, I know I need to improve my credit, but you know exactly what actions you need to take. A little checklist that you could check off. Okay, I did that one, I did that one, I did that one, I'm ready to go. And it makes you feel more empowered, because you're able to control that and really know exactly what you need to do to get to your goal. Let's jump back to questions. Any other questions pop up in here? Is the age of a collection accurate if it keeps changing debt collection companies? That is a good question. I'm not sure the legality on that. That is something that if you do know a credit repair expert, they can definitely tell you about that. But that sometimes happens, that if you have a collection account, they then sell it to another collection company, sell it to another collection company. I mean, my guess would be that they still have to follow the laws as far as how long they can collect on that debt, which is called the statute of limitations, and how long they can report it to your credit bureaus from when it was originally started. That would be my best guess, but I'm not 100% sure of that. All right, any other questions? Actually, I think if you guys have questions, you could probably unmute yourself too instead of using the chat box. Anyone? Thanks, Miss Cass. Always good to see you. I love how it's so Cassandra, if you guys don't know her, she's one of the agents here at Exit, and she is, like me, big on education. She's always out trying to educate all of her clients, bring these programs to them. So yes, I appreciate what you do, and it's very in line with what I'm doing. Okay, you are welcome, guys. So yeah, if you guys have any other questions, I'm easy to find. I'm on social media. You could just Google me. Nick has my information. Your agents should have my information. So if any other questions come up, feel free to reach out. Otherwise, yeah, I'll hang out here for a minute if anyone else has any other questions that pop up. Otherwise, I think that pretty much covered what I wanted to talk about. You're welcome, guys. Just scrolling like, thank you, thank you, thank you. So I also don't know, I don't know if Nick recorded it, if you can share this. If you can't, there was another presentation of basically this exact same one that we did last summer. And that one we did as a Facebook Live. So that one you could share if you guys, for the realtors on here, if you want to share this with your clients, again, if this one, I don't know if it was recorded or not, and if we'll have access. But if not, there's another one. If this one is available, definitely feel free to share with your clients. Great, it's a great tool to reach out to educate people. Nick, are you still around, or did you, are you on your showings? I think he's probably on his showings.
Can you provide me with your contact information? I arrived a little bit late to the meeting.
Sure. Here, let me actually do a screen share again because I think it's on my main presentation slide. Can you guys see that? It's big enough? So my email, so email is the best way to reach me. For those of you who have worked with me and know me, I am not great with phone at all. Phone is like my least popular way. I do have phone calls, but they're scheduled and they're planned meetings. So email is the best way to get a hold of me, which is my first name, Marla, M-A-R-L-A, .Barch, B-A-R-C-H, at my, C as in cat, mortgage.com. So CC stands for cross country. So that's definitely the best way to reach me. And if for the realtors, if you're introducing me to clients, the best way to do that is to put us all on the same email and introduce us. That's just easiest for me to reply and give them the steps to move forward, as well as for my tracking system, so I can create folders and drag the emails. So. Okay, now I can't see the chat box again because I shared the screen. So unmute yourself if you have any other questions. Otherwise, everyone have a great evening and good luck with your credit building. Also, if you guys have any other educational topics you want to hear about, let me or Nick know. We love bringing these programs to you guys. Like I said, we've done some in the past about multi-unit properties, which Nick calls house hacking. And that's one of my favorite topics. We've done some on renovation loans, how you can include money in the loan to fix up your new home. So any other topics you guys want to learn about, let us know. We love doing these presentations. All right, I think if there's no more questions, I think I'm gonna cut it off because Nick gave me host capabilities, so I should be able to do this.